This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 27, 2026, and this is the London session. Now, let's get into it. Fear is gripping markets right now. The Fear and Greed Index has collapsed to a deeply fearful 14 out of 100, driving a massive rotation into safe haven assets like the US dollar and gold. As we head into the New York session, the focus is squarely on whether this risk-off environment will hold or if we'll see a volatility spike when the Jackson Hole Summit begins tomorrow. Looking ahead to the next 48 hours, the absolute centerpiece is the Jackson Hole Economic Policy Symposium, kicking off tomorrow, Friday, August 28th. All eyes will be on Fed Chair Jerome Powell's keynote speech, which has the potential to completely shift the narrative on interest rates and inflation. Additionally, keep an eye on USDJPY data later today, which will provide a fresh data point on inflationary pressures before the weekend. Finally, the European markets wrap showed the dollar steadying as U.S. futures ticked higher, confirming the safe haven bid is already active in the background. The broader macro picture is defined by a rigid hawkish consensus. U.S. data has shown surprising resilience. Wholesale inventories surged to 1.3% versus a 0.2% estimate, and initial jobless claims came in tighter than expected at 203,000. This has reinforced the Fed's higher-for-longer stance, with Governor Goolsbee explicitly citing uncontrolled inflation as his primary short-run fear. Meanwhile, gold is consolidating near $4,625 as traders await the Fed chair's speech. And the VIX remains compressed at 15.45 despite the extreme fear in sentiment. We have several key headlines moving the needle right now. First, U.S. wholesale inventories for July came in at 1.3% versus a 0.2% estimate, signaling strong domestic inventory buildup. Pulse: how does this data impact the broader sentiment for the dollar? It reinforces the structural durability of the U.S. economy. When wholesale inventories surge to 1.3%, while jobless claims remain tight at 203,000, it validates the Fed's refusal to pivot. We are seeing a clear flight to safety, where capital is rotating out of risk assets and into dollar-denominated assets, because the domestic data simply doesn't support an imminent rate cut. The market is pricing in sustained higher-for-longer rates. Second, Fed Governor Goolsbee stated that his biggest short-run fear is that inflation isn't under control. SPECTER: does this hawkish rhetoric change the risk profile for volatility?
It absolutely does. You have a dangerous disconnect here. The VIX is suppressed at 15.45, yet sentiment is terrified at 14/100. This compression suggests that volatility is being underpriced. If Jackson Hole rhetoric surprises dovishly against this hard data, that suppressed VIX could spike rapidly. We are trading in a complacency trap where the market is ignoring the flat yield curve, which is currently flattened at just plus 0.47 percentage points.
Third, U.S. initial jobless claims came in at 203,000 versus a 208,000 estimate, showing labor market resilience. CIPHER: how are institutional flows reacting to this labor data?
The flows are overwhelmingly favoring the dollar. Leveraged funds are maintaining a net long stance in the DXY at plus 4,438 contracts, even if they've trimmed slightly week over week. They are aggressively shorting the euro and Japanese yen, bearish on euro at 57,716 contracts, and yen at 67,971 contracts. This confirms that institutions are positioning for continued dollar strength based on this labor resilience and the hawkish Fed stance.
Let's talk about the euro dollar. It is currently trading at 1.1655, effectively flat for the day, but structurally weak against the dollar. Grid: what are the key technical levels we need to watch?
The price action is compressing tightly. Euro dollar is trading at 1.1655, which is just 0.0013 away from its 5-day low of 1.1642. The 5-day range is extremely narrow, between 1.1642 and 1.1687. We are essentially testing the lower bound of that range. If that 1.1642 support fails, it confirms the bearish trend structure. The resistance is clearly at 1.1687, but right now the selling pressure at the lows is dominant.
That technical weakness is a direct symptom of the macro reality. The ECB is lagging the Fed's hawkish persistence, with US CPI holding at 3.3% and core PCE at 3.34%. The yield differential continues to attract capital into the dollar. The technical resistance at 1.1687 isn't just a chart level. It's a ceiling created by fundamental inflation data.
Exactly. The fundamental pressure is capping any upside rejection. We are seeing active selling at 1.1642. Until we get a decisive break above 1.1687, the bias remains firmly bearish.
Moving on to dollar yen. It is trading at 159.338, up 0.5% on the day, approaching its 5-day high. Grid, what is the technical setup here?
Dollar yen is testing the upper bounds of its 5-day range. The current price of 159.338 is very close to the 5-day high of 159.4925. We saw an intraday high of 159.4465 yesterday, so that 159.4925 level is immediate overhead resistance. The price is showing consistent upward momentum from the 08-24 low, indicating sustained buying pressure.
The positioning aligns with this technical strength. Leveraged funds are heavily short yen at 67,971 contracts. That is a massive bearish consensus that supports the upside for dollar yen. The institutional flow is clearly backing the dollar's strength against the yen.
And that flow is driven by the yield environment. The 10-year 2-year spread is flattened at plus 0.47 pp, but the Fed funds rate remains at 3.63%. This yield differential continues to attract capital into dollar-denominated assets. The technical resistance at 159.4925 is the only thing potentially capping this move, but the fundamental pressure cooker is still on. Let's look at cable. It is trading at 1.3589, down 0.5% on the day, sitting dangerously close to its 5-day low. CIPHER, what is the flow dynamic here?
This is a classic contrarian signal. Leveraged funds hold a strongly bullish net position of plus 42,877 contracts in pound, yet the price is falling and testing the 5-day low of 1.3583. This is a crowded long setup that is being aggressively suppressed by fundamental dollar strength. The disconnect between the bullish positioning and the falling price indicates that the support is artificial and highly vulnerable to a squeeze if the dollar continues to strengthen.
Technically, we are seeing support failure. Price tested 1.35831 yesterday and closed at 1.35966, but we are now right back at that level. The 1.35831 support is critical. If that breaks, it confirms the bearish trend structure. But given the positioning, a break below here could trigger a rapid flow reversal.
That is the risk. You have extreme bullish positioning, plus 42,877, against a falling price, combined with a VIX that is suppressed at 15.45. If Jackson Hole rhetoric fails to provide a dovish liftoff, that pound-long squeeze will accelerate. The technical support at 1.3583 is likely to break under sustained dollar flow.
Finally, let's look at gold. It is trading at 4,625.57, up slightly on the day, consolidating near the $4,625 level. Grid, what is the volatility structure?
Gold is consolidating within a massive 5-day range of 4,583.14 to 4,697.2. The current price of 4,625.57 is right in the middle. The 08-26 low of 4,583.14 is acting as a critical volatility floor. We are seeing consolidation ahead of the Fed chair's speech, with high volatility expected once the catalyst hits. The range is wide, indicating uncertainty.
This consolidation is driven by the safe haven bid. With fear and greed at 14/100, capital is rotating into gold as a hedge against the hawkish Fed and inflation persistence. The 10-year 2-year spread flattening at plus 0.47 pp is a leading indicator. If growth fears accelerate alongside inflation, the safe haven bid for gold will intensify.
Institutional flow supports this. Leveraged funds are maintaining a net long stance in the DXY, but the rotation into gold is evident in the safe haven positioning. The current consolidation at 4,625.57 is a pause before the Jackson Hole catalyst. We are waiting for the Fed chair's speech to determine the next directional move.
Apex, bring it all together. What is the unified trade thesis for today?
The market is structurally priced for a hawkish higher-for-longer regime. Grid flagged the critical technical failure points at 1.1642 for euro and 1.3583 for pound, and CIPHER confirmed that institutional flows are heavily short euro and yen, while pound longs are crowded and vulnerable. Pulse highlighted that the US data beat on inventories and jobless claims validates the Fed's hawkish stance, driving the safe haven bid. The synthesis is clear. Dollar strength is fundamental and supported by flow, but the suppressed VIX at 15.45 creates a risk of a volatility spike if Jackson Hole surprises. The bias is toward dollar dominance, with gold waiting for a catalyst.
To summarize, the US dollar is structurally strong due to resilient data and hawkish Fed rhetoric, with euro and pound facing technical and flow pressure. Dollar-yen is testing 5-day highs, while gold consolidates ahead of Jackson Hole. The key risk is a volatility spike if sentiment and VIX diverge further. Tomorrow, watch for Fed Chair Powell's speech at the Jackson Hole Summit. This has been the ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.